So let's get the press question out of the way. Tell all these folks why it matters whether we vote to raise the debt ceiling or not. I tried to explain, by the way, before you got here, that America's maybe the only big country in the world where the legislative body has to do this. Everybody else just takes it for granted. If you spend more money than you're taking in and you borrow it, you have to make good on your promises to pay. That this is not about voting for future deficits, it's about honoring the past. But what is the significance? If this is turned into a political deal and we don't raise the debt ceiling in a timely fashion, what are the consequences?
Good question. If Congress doesn't act, but they will act, of course, in the end they'll do the right thing, then what will happen is interest rates will rise, we'll have to pay more to borrow if we're still able to borrow. The cost of borrowing will rise across the country and across the world for every business, every family. Equity prices will fall, value of savings will fall, and you'll see more people out of work, more business fail, and it will be unthinkably damaging to the economy, much more damaging than even what we faced in that period, in that dark period in 08 and 09. But as you said, this is about the past obligations of the country that Congress has authorized, imposed on us in some sense, and we're the United States, and we're a country that meets its obligations, and I'm sure that Congress will do what it's always done in the past and pass it. But the other reason why it's important, of course, is we're having this debate about how we go back to living within our means. You know, voting for the debt limit is never popular, and I think understandably, people who have to vote for the debt limit now want to have the chance, too, to vote for something that restores some gravity to our long-term fiscal position. So we're trying to negotiate, because it's a good thing for the economy now, we're trying to negotiate something that lays out a long-term path. You've talked about this. Gives people some confidence that we're going to go back to living within our means, so we have some room to afford the things we're going to need to spend, to do and invest in, to grow in the future.
Well, first I want to hammer home just that one point. For members of Congress of both parties, including some of my best friends, very often in the past, the debt limit vote has been a chance to just cast a no vote and say, I'm voting no to protest X, Y, or Z. And no one ever cared, because we always knew there'd be enough votes to vote to raise the debt limit. And I think most Americans thought, because except for the last 4 years I served, we've been on a permanent deficit path for a long time, and really since 1981 on a big deficit path, that there were no consequences. It was a good thing that most people thought we were voting for future deficit spending ad infinitum. That is not true. Voting to raise the debt limit is voting to honor the obligations we have on the decisions that have already been made. And most Americans don't understand that. The second thing is, most people don't understand that this just means that they think, well, maybe this is a way to force them to cut spending. This is a way to force us to increase spending, because interest rates will increase, and of the dollar you pay in taxes, a higher percentage of it will go to service the debt, and a smaller percentage will go to green energy, to manufacturing, to building jobs, to community financial institutions, to education, to healthcare, to you name it.
But let's just make sure that we make this clear, because we really have no option to go into a period where we don't start paying our bills. You know, if you just think about an average family, if you're a family and you had to refinance your entire mortgage every month, and you decided that you were going to stop paying the bills and all the things you purchased, you not pay your utilities bills, don't pay your car loan, default on those obligations, and you have to go ask your bank to refinance your mortgage, is the bank going to do that? They're not going to do it. And you know, we have to borrow 40 cents for every dollar we now spend, because of the obligations Congress has authorized, created. So Congress has no choice but to pass this, and I'm sure there will, but you know, we're hoping we can negotiate a long-term fiscal sustainability plan that'll be good for the economy, create some room for us to invest in the things we need going forward.
Now, let me ask you a second question about that. I thought the bipartisan commission that the President appointed, the Bold-Simpson Commission, did a very good job with a very tough subject. And I didn't agree with every recommendation they made. I'm sure you didn't, and that means they were thinking and we're thinking. But they did deal with this over a 10-year period. I want to ask one specific thing. They said that we need a plan, and by sending this plan out, if this plan or some plan like it is approved, it will increase confidence. It'll help America get started again. But we shouldn't implement this plan until we're sure that the economy is on sound footing and growth is on the way. And the reason is, then you get what happened when I was president. When you contract the public deficits and you, in effect, reduce the public sector's take of the economy, it will provoke even greater private activity and you'll have net more growth. But the timing is important. Do you still agree with that? Do you think that's important?
Absolutely. You have to do this in a way which is, you may say, growth friendly, where you phase in the cuts that we need, the savings we need, over time. And you want the pace of those cuts to be calibrated to the strength of the recovery. There is no credible argument now with interest rates where they are now, 10-year rates now for the Treasury are 3%, that by cutting deficits today, rates would fall and stimulate growth in a way that would be helpful. They would only fall if they thought we were going to fall off the cliff again in some sense. So you're absolutely right that you need to do it in a way that gently phases in the savings over time, and you have to do it in a way that is balanced, carefully balanced, so you're not cutting things that are really important to our capacity to grow in the future.
Now,
but can I say, Mr.
yeah,
President?
Sure.
You know, people say, a lot of people say, why now? You know, we have 9% unemployment. Biggest challenge we face is growth and jobs. Why is Washington so focused on the deficit? It seems a misplaced priority. But I think you should think about it this way, which is, and I think you faced this in some ways in 95, 96, which is right now, until the American political system is able to demonstrate that they can come together and put in place some long-term reforms to get ahead of this problem, get our arms around this fiscal problem, nothing is possible for the economy, for the investments. We just can't, realistically, you can't do it. Partly because people are so worried about the deficits, they want to show that we can demonstrate a capacity to save, to be more careful with their money. But if we do that, if we can lock in some long-term reforms, then we'll have a chance to turn our attention much more aggressively to the many, many other challenges we face as a country, and we'll have more room, more ability, more confidence to do that. And that's why it's important to do now. It's not just because we have a debt limit vote, but it's because we have unsustainable deficits as far as the eye can see, and we will not have the political oxygen or the ability to turn to those challenges unless we can demonstrate we've got some broader path to live within our means.
The reason I brought that up is, first of all, I agree with what he said. I think that it would help us enormously both within America and around the world if we showed we had the discipline to come up with a, let's say, a 10-year plan. But when we started is also important. And there are people in Washington who disagree with that. They think the only thing that matters is just cut now, who cares what the condition of the economy is. The United Kingdom tried that, and so far they're not having very good luck. And the theory of that is, if the banks are already flush, the confidence factor will be so enormous, people say, thank goodness, and they will throw money at the economy. But where are they going to throw it if there's not enough demand? There's a real chance that in the UK, if they started too soon and they did too much, that government revenues will fall even more than spending is cut, and their deficit at the end of the year will be bigger than it was when they started. So that's why it's important both to have a plan and to calibrate when you start it and how steeply you implement it. And I think that's important.
I also think that there's another thing that is about confidence in this, which is that I think part of the cloud over the country, part of the uncertainty around the country today is, you know, is our political system up to managing the challenges we face? Do we have the capacity to get people to come together and solve some problems? And even though interest rates are low, and you don't have the conditions you had when you moved the country to fiscal responsibility, I think there will be a benefit to the country in terms of confidence if people see Washington work in that capacity, start to make some harder choices. I I think it would be helpful, and it give people more certainty about what the long term is going to be. And, you know, we are living with a tax system which has too much uncertainty, too much distortion, too much year-by-year uncertainty to it. Very hard to make plans for the future in that context. And, you know, we just got to demonstrate, even though the country is very divided in many ways, we have to demonstrate that Washington can work to get ahead of these long-term problems. And I think that would be good for confidence.
Let's talk about one potential source of revenue that doesn't constitute a tax increase that we might get bipartisan support in, and that's all the cash being held by American companies overseas. There are all these proposals to repatriate it, but as you know, when this was tried in the previous administration, they got a lot of money back in, and the government got a one-time infusion of the tax. It was a very low tax, but it was more than we would have had if the money had been left overseas. But very little of the money that was left was reinvested in American jobs. And as I believe, there's a study saying that a lot of this money would have come back anyway, and the government actually lost money. So what should we do with the whole issue of having a competitive corporate tax structure? The corporate tax rates in America now the second highest of our major wealthy competitors, but the corporate tax take is not the second highest because of all the tax, what they call tax expenditures, loopholes in the law. So what should we do about the cash that's overseas? What should we do about having a competitive corporate tax system?
Well, we got to do corporate tax reform. As you said, we have the highest statutory rate in the world, although the average effective rate is close to the average of our major competitors. But you know, it's an unfair system, huge amount of uncertainty in it. What you pay in taxes relative to income is not determined by how successful you are, how efficient you are. It really is determined by, to be a little unfair, the quality of your lobbyist. Huge unfairness. Some firms pay way under the average, some firms pay way over the average. So it's a good thing to do, and we want to do a comprehensive tax reform that creates much stronger incentives for investment in the United States. It has to be done in a revenue neutral way over time because, you know, we got big fiscal problems. But we want to do it in a way that lowers the rate, broadens the base, creates stronger incentives for investment. And as part of that, we think we can do a pretty significant one-time incentive for people to bring some of that money back. But you're absolutely right about the past. Right now, you know, American companies have a couple $1 trillion on their balance sheets of cash in the United States, and they've got, I don't know, maybe some people say $1 trillion overseas. And I think our big challenge over time is, again, do things to maximize the chances that more of the investment the world's going to need takes place in companies that are building, creating things in the United States, and getting the tax system better as part of that. But our focus should be on long-term, permanent reforms to create better incentives for investment here. And the only path to that really is through comprehensive corporate tax reform.
Let's ask another question. Now, when we came here, I told all these folks that, and my numbers may be a little off, so feel free to correct me. I'm wrong about it half the time. But we have, the banks of America have something like $2 trillion in cash uncommitted to loans already. And I think still on mortgages for which they're still liable, which may be underwater, something under $200 billion. So there's $2 trillion there at very conservative loan to deposit ratios, and in theory they have $20 trillion in loan capacity. How do we do more to unlock that? And do you believe, how would you allocate, do you think that the lending levels are low because there's not enough good loan demand, or because the banks are reluctant to lend? And how much, one final thing, how much of this reluctance to lend is due to the criticism that the administration's received of regulatory uncertainty? Where is there any merit in that? And if so, what can you do about it?
We had a crisis caused substantially because people borrowed too much relative to their income, and we had too much leverage built up in the banking system. And as the economy went into crisis and the economy was shrinking, demand for lending fell dramatically. And even as we recovered, even as we're recovering today, people are still reducing the amount of debt they hold because they hold too much debt. So demand for lending has been very soft throughout this process. But the banks now have much less leverage. We forced them to rebuild their capital cushions hold a lot more capital against risk now, and the challenge now is to get them to put more of that at work. So as the economy recovers, they're supporting a growing economy. I do not believe now that for the economy as a whole, the banking system is getting in the way of recovery. It's true that credit is tighter. You know, if you're looking for work still, and your credit's not so good, it's much harder to get a loan today than it was in the boom. And if you're a small business in parts of the country, unlucky in your bank, it's harder to get a credit, no doubt about it. And that is going to take a lot of time to heal and improve. But banks have a lot of capital today. Most companies across the country can fund a growing business. I read a report this morning that even small business lending's rising significantly again. That's all healing and thawing, and that's good. Now, what about these concerns that regulators are overdoing it, that examiners, having been a little too soft in the boom, are too tough now, or that the Dodd-Frank reforms are going to deter banks from putting this capital to work? It's absolutely true that it happens in after any crisis that the regulators are being tough and that examiners are being tough. And I think that's part of the problem. I think it's a relatively small part of the problem, and important they don't overdo it. You know, a loan today is almost by definition much less risky than a loan in '07, you know, before we went into this mess. So the regulators can be a little more confident now. Banks have a lot of capital. They should be a little more comfortable now. And the banks should be, frankly, willing to take more risk now and take a chance on recovery again. We're going to be very careful as we implement the financial reforms to make sure we don't overdo it. You know, we're going to make sure this system is much more stable, much more protection for people, much less risk. But we want to make sure that we're not hurting the recovery and we're not hurting the level of efficiency, innovation, creativity that anybody needs. And you know, our financial system, I think we're way ahead of the rest of the world in repairing the damage. And I think we're going to emerge from this much stronger than our major competitors globally. And we're going to make sure we have very high standards, but we return the system to what it once was for a long period of time, which was the best system in the world for channeling capital to startups, growing innovative companies. And that's starting to happen again because we were so aggressive in the crisis, and that'll get better over time. And I think we're going to be able to make sure that the natural conservatism of regulators now doesn't get in the way of that.
Well, let me ask you something else. As you pointed out, for small business access to capital, it may just depend upon whatever the individual circumstances of a community bank or a regulator. To what extent can we level that? Also, to be fair to the banks, the cost of processing the loans and complying relative to the size of the loan will ensure that the profit margin may be lower. To what extent can we overcome that through community development financial institutions, through more aggressive use of SBA's loan guarantee authority, or to what extent can we encourage or maybe even accelerate the venture capital business by federal policy? Those, I think, are the three major sources of cash we could have for startups. And we were saying here today, a big percentage of the new jobs are created not just by small businesses, but by small businesses that are 5 years old or younger.
Yeah, exactly. I think that getting capital and guarantees to banks through the small business lending programs we have, through the CDFI fund, and using tax policy carefully, like in the New Markets Tax Credit, or we have a framework in place that allows for zero capital gains for investment in small businesses for a period of time. Things like that are very good. The tax incentives are obviously smart, and getting credit capital guarantees through the SBA, the CDFI, and the small business lending programs that we have in place are very good. I'll give you an example. I was in Manchester, New Hampshire the other day, a place you spend a lot of time in. That's a small business state. Exports in New Hampshire growing much more rapidly than the rest of the country. Manufacturing heavy state. A lot of good things happening in manufacturing. They've had no bank failures. over this period of time. Unemployment's much lower than the national average. They didn't have a huge house price boom because they were more careful, frankly. Banks were more careful. They're coming out of this better. And I sat around a table with a group, and there was a guy there who is in the business of making equipment for firemen. And he was able, a huge increase in demand for his products. He makes a good product. And he was able to go to a state credit program that we're supporting with capital from the Treasury to get a loan to help expand a little bit. So things like that have a very high return, very good use of a marginal dollar taxpayer's money. You know, as you can see, the bank investments in the TARP program, you know, not popular. No one would want to do that. No one would ever want to do that again. But very, very effective use of a dollar of resources, and the investments we made in banks in the crisis are going to yield well over $10 billion in return to the taxpayer over time, just like those programs, CDFI, New Market Tax Credit, the small business lending funds are good policy right now. We should do more of that. And you know, the basic lesson of crisis is you want to keep at it. You want to keep doing it. You want to keep looking for ways to unlock more of that capital.
One of the most interesting things to me about the presentations that have happened here before you came are the number of people who described how they got started. And we had a representative from South Dakota here who comes from one of the poorest communities in the country talking about how the Community Development Financial Institution funds made a big difference. You know, we started those back in the 90s, but President Obama and Secretary Geithner have been very aggressive in supporting them. And you can actually make money doing that, and the economics of having the federal government seed these programs make them much more able to help these startups, to help these small businesses. And we talked a little bit earlier today about the New Markets Tax Credit, because there's a company here that's going to try to put a lot of solar panels on the roofs of historically black colleges and universities, and what makes the economics work for them is the New Markets Tax Credit. So I think that plus the venture capital will make a lot of difference. But let me ask you just one more question. We'll wrap up this section of it. When all this happened, I got a lot of criticism, as you know, because I signed deregulation became a very bad word for good reason. We had banks were over leveraged and nobody stopped it. But the criticism that I received was that I signed a bill which eliminated the Glass-Steagall barrier between one institution engaging in traditional commercial banking and also issuing securities and otherwise becoming investment banks. And people said that hastened the meltdown. What's your real take on that? What was the impact of that on the meltdown?
Mr. President, I do not believe that that played a significant role in the calamity we faced. I'll explain why. Just again, look back a little bit what happened. You had classic commercial banks fail across the country. Very, very large ones, some of the largest in the country, not doing the fancy stuff, and some small, medium-sized ones across the country. And you had a lot of guys doing complex stuff in New York, Wall Street investment banks, Bear Stearns, Lehman Brothers, AIG. You could say Fannie and Freddie were in this business too. Took a huge amount of risk. And the big mistake this country made was that it allowed a huge parallel banking system to emerge alongside banks, simple classic banks, with no constraints on leverage. So a huge amount of risk built up over here in a system that was as large as the rest of the banking system, with none of the checks and balances or the safeguards we put in place around banks after the Great Depression. And when the storm hit, those things came crashing down, putting huge pressure on the economy, causing a lot of damage to the innocent. But you saw garden variety plain vanilla banks fail, and you saw banks that are operating on the other side of the capital markets fail. And the only solution to that in the future is to make sure everybody is in that business, holds more cushions, shock absorbers, safeguards against risk. Just one more thing on your question. You know, Canada had universal banking long before you passed the Graham-Leach-Bliley reforms that ended Glass-Steagall, and they had a very stable system. Most of Europe had that system. Some of Europe did kind of poorly in the crisis, had a worse crisis than we did. Some we did fine, but it wasn't that separation that protected us in the years before, and its removal didn't hurt. Another way of thinking about it, you know, banks are in the business of doing two things. One is helping businesses raise capital, credit, equity, hedge their risks, and there's no reason really why you want to separate part of that and say this type of lending capital these guys can do and these guys can do the other part of it. No reason to do that. The main thing to do is to make sure people hold more capital against the risk they face, which is exactly what we're doing. And we're going to be careful, because I want to emphasize, we're going to be careful not to overdo it. We won't get the balance perfect, but U.S. banks have much more capital today. They're way ahead of their international peers, and they're in a very good position to meet these high standards and still have the capacity to help finance the growth we're going to see ahead.
When you announced the new capital standards, actually bank stocks went up in value, right?
Yeah, they did, in part because certainty helps. They know what the rules of the game are. In part because they were a little scared that, you know, the Fed was going to overdo it, so they're a little relieved on that stuff. But these are very tough new standards. They're dramatically higher than before the crisis, as they should be. And this is the key thing Dodd-Frank did, was we now have the authority to apply those requirements to any large institution that's fundamentally in the business of banking and taking risk and leverage that could cause a lot of damage to the innocent. And that's a hugely consequential reform. It'll make us much safer in the future.
Yeah, I just want to make this point about it, just because I don't want to beat a dead horse, but if you look at the collapse in England, if you look at the collapse in Ireland, if you look at the collapse in Iceland, if you look at the collapse in America, we all have radically different financial institutions. They have one thing in common. They basically had too much leverage. Too many loans at higher and higher levels of risk with too little cash to support them. And I personally believe that even though there had been some kvetching about all this, this is the most important thing. More important than every other thing that's been done in this whole area. And I think I'm personally grateful that you're doing it. So what would you advise all these people to do? What can we do collectively we haven't done to unlock more of this lending that is now clearly available, properly supported by the rules?
You know, I think it's the big fundamental stuff that matters the most. It's clarity in what the rules are that determine the economics of finance, like capital requirements. It's confidence we're going to have a long-term fiscal plan in place that restores responsibility. It's better incentives for investing in the United States. It's doing a better job of taking advantage of the huge growth we see outside the United States through more aggressive export promoting policies, tougher trade agreements, allow us to participate in those markets, and it's figuring out how to finance the huge infrastructure needs of the country. Those are important fundamental things. They're not everything. Huge thing that matters for us will be, of course, what we do to improve education, training in that context. But I would focus on the big things in terms of policy, and that'll make it more likely that you see more of this capital put to use, and you'll see more of this huge demand we're going to see outside the United States for a long period of time to come, met by companies that are creating things here. You know, remember, we're like a quarter of global GDP, 5% of the world's population, and you want the typical American company, manufacturing company, to be like so many American companies today, where 70% of their revenues are outside the United States. Most of the growth is there. It's true, it's going to happen, but they have 50% of their employees here. And we have a very good chance to come out of this with the classic resilience, innovation of the American economy, stronger, not meaningfully affected by the crisis, as long as we make some sensible decisions in the months ahead.
Let me ask you this. Even though the debt held, the mortgage debt held by banks directly, and their liabilities, if they should all fail, as we pointed out, is a small percentage of the cash they have now that otherwise is free to loans, most people seem to think, including me, that the psychological impact, of nothing else, of trying to finally clean up this mortgage business and give certainty to mortgage holders, either they're going to be foreclosed or they're going to be able to stay at home, would be a good thing. How can we do that? And this settlement that was announced yesterday in the Bank of America case, is there any hope that that's sort of the beginning of a process of resolving all this? I know you've done a lot of negotiation with the state's attorney general, and I think it'd be helpful for people here to just know that where you think this is and where it's going.
Well, as all of you know, we're still living with a terribly tough housing market, and we have a system where we have a set of servicers that, frankly, did not have the resources to do their job and help their customers through this. Huge amount of legal uncertainty around the settlement foreclosure process because of all the mistakes they made. And a lot of people out there that have the resources to stay in their home that need to be given a chance to stay in their home. A lot of people out there that can't afford to stay in their home or need to move to take a new job somewhere else but can't get out of their house because they're underwater. And we have got to move more quickly to try to clean that up, being some uncertainty. So we're trying to negotiate the Justice Department's trying to negotiate a comprehensive settlement with all the servicers, all the bank servicers, with the state AGs, and with all the federal entities like the FHA, that will have in place clear, tough, enforceable standards on servicers. So it's clear what they have to do to help their customers get through this, help bring much more legal certainty to the broader settlement foreclosure process, so that process can move where it has to move, and to try to make sure there's much clearer requirements to help those people who can afford to stay in their home, get a modification allows them to stay in their home, and for those that really can't, give them the chance to transition to rental or be able to move to take a new job somewhere else. That's what we're trying to do, and I hope we can bring this to earth reasonably soon. That would help with some clarity and confidence too.
As an economic matter, in your opinion, does it make any difference how the mortgages are redone? That is, does it matter, is it better to write down the principal value so that the value reflects the value of the home and that makes it more sellable, or is it no different than just saying, well, we'll give you longer to repay it or change the interest rate or something like that?
You have to do both, and you have to do it, it depends what the circumstances are. In some cases where the rational thing for the bank to do, the investor to do, is to write down the value or make a short sale possible, or make it easier for you to go off and live somewhere else. But in some cases, the sensible thing to do is to reduce the value of the monthly payment so you can afford to stay in for a time, give people a chance, find a new job. And both those things do reduce the value of your obligations, and they can both give you meaningful relief. Have your disposable income goes up. The housing programs that the president put in place, on average, gave the eligible family $600 a month more in additional income. They weren't having to spend on a mortgage. And
how many people have accessed that? 700,000? Is that right?
Only 700,000 in the programs where we're putting taxpayers' money up to help make it possible, but 2 to 3 million in modifications done by banks outside that program. And so much broader, we set a broad standard for the industry, and you've seen a significant reduction in foreclosures since the first half of '09 because of the cumulative impact of those things. But still, it is terrible, hard, painful, and what's tragic about this, of course, is just the amount of collateral damage to the innocent. There's people who were very responsible, didn't borrow too much against the value of their house, took out a conservative mortgage, but they've seen their house price decline because of a bunch of other judgments made by others, and that's why this is such a unfair and tragic burden to leave the country with, and why it's so important that we keep doing everything we can to make sure we work through that process and help those people who can afford to stay in their house.
I also think it's worth pointing out, by the way, that we should be in favor of every one of these rewrites and write downs as possible, not just for the people who live in the homes, but for their neighbors, because every time you have a foreclosure, it lowers the value of everybody else's house in the neighborhood. And this is one where we really, what I'm hoping, what is the countrywide at like 10 million mortgages, and Bank of America another 4 million, so you're looking at 14 million mortgages, and it's something like 4 in 10 of them may be higher than the present value of the home. So if they work through this process in an orderly fashion, then maybe that'll help you to make the deal with the Attorney General, and so we can move it through the country and get it behind us.
It might, let me just, I'll just say this to the participants in those discussions. It is important for all of you, servicers and the state AGs and the federal entities who are trying to do the right thing for the American people, to bring this to earth. You know, there's a tendency in these things where everybody wants to hold out for something better, something fairer. But I think the fairest thing for everybody now is to try to bring this to bed for just the reasons you said. You know, we need to do everything we can to make home ownership work again. And part of that is people being a little more realistic and a little fair on what their expectations are, where we can settle this deal.
Well, I want to close on 2 sort of upbeat questions. We got to wrap up. Where do you think America will be in 5 years? Where do you think America will be in 10 years?
I think America will be stronger, better, more confident. And the reason I say that is because, you know, it's sort of a dark moment in the country, much more uncertain moment. And that's mostly because, you know, we're just living still with the scars, the damage caused by, you know, worst crisis we've seen since the Great Depression. And a lot of what makes growth slow now and so hard is just the process of people bringing down their debt burdens, working through the huge excess of housing we still have, banks bringing leverage down. Those are things we have to do. We have no choice but that. But they make this thing slower. But if you look at the rest of the American economy, and you look at the incredible improvement in productivity, you know, GDP today, the entire output of the American economy today is now 3 to 4 percentage points above the pre-crisis level, but we have 9 million people still out of work. So the gap of that is productivity. It's tragic in its costs in the short term, but it makes U.S. companies in a much better position to be effective, competitive globally. And if you look at the scale of innovation across the country, what's happened in technology, manufacturing, agriculture across the country today, this is a very resilient economy, and financial system is going to be dramatically stronger, much restructured fundamentally, dramatically stronger. And I think we'll be, if we can get this fiscal stuff in a better place, we will still be the most effective, most competitive major economy, growing significantly more rapidly than the other major economies. Not as rapidly as China and India and Brazil, but we should be growing, you know, significantly faster than the other major economies. And I don't see why, Mr. President, why our future does not look like the economy of the 1990s, when, as you said, with responsible fiscal policy, you saw a remarkable increase in private investment, sustained growth, and not just jobs, but income growth, broad-based income growth, huge productivity gains. There's no reason why that is not our future. Again, if we can, you know, repair the damage caused by that lost decade in between and bring our fiscal position down in a more sustainable place, because this is a very strong, very confident, resilient country.
Well, I just want to say one thing. I think that's great. We talked a little backstage. We don't have time to get into it today, but one of the functions of government, and this is why we have to be so careful of letting all these discussions be talked about in terms of whether you're for or against the government, and it's all about taxes and all of that. Every successful economy on the face of the earth has a strong private economy and an effective government. And one of the things that we have to do is figure out ways either for the public or private sector to aggregate enough capital, even as we bring the debt down, to rebuild the infrastructure of the country. And not just the roads and the bridges and the rail and the water and the sewer, but also to speed up the interconnections and the internet, and to figure out how we can have a genuine national electric grid so we can maximize wind energy where the wind blows instead of where the people live. But if we do that, I think it's a mistake to bet against America. We're still better positioned than most places on earth.
And I talk to people who run businesses, of course, across the world all the time, and you know, I'll tell you what they say to me. I mean, they say that if you are a global company you are much more fortunate if you are a company building stuff in the United States, located in the United States, because we have so many advantages other countries have, and I would not trade our problems for any other country's problems on the planet. Now, we got a lot of challenges, but most of what feels so hard and bad about this country today is just the unavoidable, necessary aftershocks of that calamity. And it's important to help people understand the great possibility of this country. Now, Washington, has got to do a better job of trying to solve the problems of the country, and got to find a way to get people to come together and solve some problems. And that's why this budget deal is going to be such a test of the American political system.
Last question. We'll end on a press question, like we started. They say there's all this speculation in the press that once you get an agreement to keep from shutting the government down and turning our credit rating to shreds, that you're going to go off into the sunset and do something else. What are your career plans? This is a job we can create or maintain here. Let's tell it.
As you said, Mr. President, I've never had a real job. I've only worked in public service. But, I live for this work. It's the only thing I've ever done. I believe in it. We have a lot of challenges as a country, and I'm going to be doing it for the foreseeable future. People are a little worried or interested because, I have a family, and my son's going back to New York to finish high school, and I'm going to be commuting for a while. But I'm going to be doing this for the foreseeable future.
Good for you. That's good for America. Thank you. Let's give him a hand.